So, good evening, everyone, and thanks so much for being here tonight. I truly, truly appreciate it. Um, a week ago, I did a class talking about hedging individual stock positions, And tonight, I wanted to talk about how we can do that with overall portfolios. What can we do to hedge a portfolio all at once? Is anybody right now kind of wondering when or if this market is going to come off the rails here eventually? And wondering how you can manage around that? Yeah, me too. I'm becoming more and more concerned the more we rally up that at some point in time, um, we could have some problems. But what we can do is we can do some things with our portfolio that I think a lot of folks may not know much about, and so we're just going to dive in. There's not going to be any slides tonight. Let's just dive in and let's actually take a look at some of the things that we could do to hedge a portfolio overall. Now, and I'm going to use this black screen here, do a lot of drawing and things tonight. And by the way, I always ask questions. I always want people to be involved in the class. So let's think about this. If we are seriously concerned about a market turning lower, what's one of the first things we should be doing? You could go to cash, taking profits. That's right. A stiff drink. That's right, B12. Take some risk off. Take some risk off. And that's one of the things that I've been kind of warning people about in the morning prep videos. When we stretch a market out, we need to be, and we start getting worried about things falling apart. You guys would have to agree, even though there's several of us in here kind of worried that there may be a bit of a pullback coming, the overall trend of the market is still up though, right? And so we want to continue to trade that trend to the upside as long as this lasts, because who knows, it might be months from now before this comes off the rails. Okay. Heck, it could be a year. We don't know. It could be tomorrow. But we want to be able to trade with the direction of the market and make that money while it's happening. So one of the things we have to be thinking about is in the trades that we're in, something I repeat over and over and over, and you guys hear me say this over and over and over, is we cannot be consistently profitable traders unless we get comfortable with the idea of taking profits consistently, right? If we can learn to take those profits, and particularly when we're nervous on the market, and we're seeing a lot of stocks that have been moving up, but they are really stretched out and stretched away from trends. What's happening right now is a stock starts to move and it seems like there's just this massive pile in, and we overextend it really, really far, really fast. Okay. And one of the things when this does come off the rails, it's stocks like that are really going to be punished heavily. How many of you guys have ever had a nice winning trade, tried to squeeze out a profit? You just want it, that greed kind of kicks in. You just want that to go just a little bit more. And the next day, all of the money is gone. Right? No idea what I mean. That's right. Gone plus a possible loss. And that's why we need to be a little bit quicker in a market like this when we get these moves that kind of seem to extend out. We need to be thinking about what is our job? So one of the first methods that we can do to control our risk in a market like this is when we get that move, don't allow greed to make our decisions on trading. Our job is to make money, right? Our job is not to pick the perfect entry or catch the perfect exit. Would you guys agree? Even though a lot of us really work really hard to try and be the perfect trader, that's not what we're here to do. We're here to grow our accounts. We're here to make money. And if we don't learn to take profits, okay, in a market that is kind of extended looking like this, we could get up one morning and have that real headache, okay, where everything kind of went bad. So number one is we have to start thinking about taking profits quicker and have to start thinking about reducing our risk when we start to see that there is that evidence that the market is kind of stretched out or a stock is kind of stretched out. It's time to reduce that risk, okay? Now, I'm not telling you you have to close the entire trade, but what would be wrong with closing 75% of a trade like this and then waiting till tomorrow to see if it extends just a little bit further? And by the way, there's nothing wrong with just closing the trade and walking away. We put money in our account. That's our job, to make money. We're not here to pick the perfect entry or the perfect exit. Our job is to make money. So if we take care of that part of it, if we kind of reduce our risk when we should, putting some money into our account and paying attention, what's another thing that we can do to help avoid high risk in a trade? Well, one of the things we're seeing right now, and I get a lot of comments about this, is we see that stock that has moved up really sharply. And isn't it true when we see that stock that's moved up really sharply and they're all around us right now, we want to chase them? Right? It's like that dog that has that habit of wanting to chase a stock. Yeah, all the pot stocks. That's exactly right. We just want to chase and we want to chase and we get that urge and the fear of missing out and all of those things happening in a trade like that. So one of the first things we need to think about when we see that stock extended is sticking to our rules. No, I don't chase stocks that are already extended. The risk of that pullback is too large. Okay? Is too large. So you have to limit or make sure you're over trading an extended market. Okay? So we need to take profits and we need to think about not over trading extended markets or extended stock issues. Okay? Now, what I'm going to talk about here tonight is maybe a little bit different than something that you have heard before. But one of the purposes for options, one of the purposes that they were created is not for speculation trading. The purpose that options were created for was for hedging. There were two guys that won the Nobel Prize, a guy by the name of Black and a guy by the name of Scholes, that created the model, won a Nobel Prize because it helped institutions manage risk. And that's really what options were created for. Okay? Is to manage risk. It's not what it's kind of become today. You know, a casino game is what it's turned into. Just all risk all of the time. Everybody's a stock expert. Ridiculous stuff going on right now in the market. Options were created to hedge risk. So I'm going to talk about a plan how you can work through some of those details and put together something that makes some sense if you feel like the market is starting to show some risk. Okay? Number one, we're going to take some profits. Okay? We're going to take some profits and we're going to reduce our risk to the market. Now, if you don't have any profits to take, you can still reduce your risk to the market by closing some bad trades, correct? We're going to close some positions. Okay, that reduces our risk. If we really are in fear that the market is going to roll over, then we need to start managing our risks. So number one, profits or closing risk. Okay, we need to reduce. All right, number two thing we need to do on those stocks that we choose to hold, what would be the next best thing to do? If we choose to hold a few of those trades, some of that risk, what should we be thinking about? That's right. Lee's got it. We need to be thinking about and evaluating where those stop losses should be. Okay? We want to make sure that we're putting in some stop positions so that if the market does turn over, we don't turn winning trades into big losers. We've all done that, right? Every single person in this room that's traded very long has held that trade thinking that they could manage that position and it will bounce back. Right? It's going to bounce back. It's going to come back. How many in here are willing to admit that's how you turned, that you have turned short-term swing trades into long-term holds by doing that? Right? We've all done that. It'll come back. It has to come back. And then when it doesn't come back, you hear yourself say, I can't afford to lose this much money. I have to stay with this trade. Right? Now, there's going to be a day in this market where this buy the dip mentality, every time the market pulls back and people rush into the market to push it back up, there'll be a day. It happened in 2008. Okay? It happened in 2019. It happened at the tech bubble crash. That all of a sudden, buy the dip no longer worked. As a matter of fact, it went the other way. People lost their accounts really fast. Okay? Broke their accounts really fast, continuing to not recognize that the market condition had changed. Okay? So make sure you evaluate those stop losses. Now, I saw someone say, tight stop losses. A tight stop loss is okay if it's meant to just protect profit. Okay? But if we set our stop losses too tightly, we kind of almost guarantee ourselves a stop out, right? When I work with people, all over the United States, coaching and things like that, one of the things that I find is people that have a win-loss ratio where they're actually losing more trades than they win. It's usually because of improperly set stops. They think they're doing the prudent thing by limiting their risk to a very small number. But what ends up happening is they end up just getting themselves stopped out a lot. They get lots of little stop outs. I call it death from 1,000 paper cuts. You bleed out just the same, but it's really slow and it's really painful. That's the way it felt, Lee? Yeah. I've been through that, and I know a lot of folks have. So we have to make sure that we're setting our stops correctly based on the price action of the chart. And if we're trying to protect the capital, it's okay to set it, or protect a profit, it's okay to set it tighter if you're willing to get stopped out. Okay? Exactly. Get stopped out, and then the stock turns around and runs right back up. It's almost worse, isn't it? It's almost worse when you set the stop too tightly. It stops you out and then reverses and goes up, and you're sitting there with a loss, and everybody else around you is making money. Okay? Solo did that to you today? Yeah, I understand. I understand. Um, yes, you can buy puts. And we're going to talk about this. Remember, what I'm talking about here is hedging an entire portfolio all at once, not just individual positions, but hedging a portfolio. So when we step forward from here, we've taken our profits, we've set our stops correctly, we've evaluated those carefully. The next thing I think that is important we need to do is we need to add up our delta. Okay? Add up our delta position. Some folks don't know this, but when you own stock, for every share of stock, you have one delta. Okay. One of the great reasons that Delta, or one of the great things that Delta can help us with, is telling us what our risk is in the market. Let's say we add up our entire Delta position, all of the positions we have, stock and option positions, and our Delta ends up coming out 2,000 deltas. Okay. So we're 2,000 deltas long. Now, how do we reduce that 2,000 long delta? We've already decided we want to hold these positions. We've gone through this process. We want to hold these 2,000 deltas. Okay? But we want to hedge the portfolio. We want to hedge the entire thing. Well, this is how I go about it, and you can decide whether or not this makes some sense to you. Okay, this has worked really, really well for me. What I normally do is I start with 20%. What's 20% at 2,000, guys? $400. Yep, 400. So if I wanted to reduce my long delta risk, I would need to pick up 400 negative deltas. Okay? So I'm reducing this by 20% by adding in 400 negative deltas. Now, let's think about this for a second. If we're wrong and the market doesn't sell off, okay, how is this going to work out for us? If we're wrong and the market doesn't sell off, we have 2,000 long deltas, we have 400 short deltas. If the market doesn't sell off and continues to go up, we're still going to make money, right? Based on our delta position, we're still going to make money. We're going to lose some money on this, and we're going to gain money here. Yeah, but what we've done is we've laid off that 20% of that trade, okay? So as long as we put on that 400 risk and manage it, right? If the market goes against us, we close that risk, we take those small losses, and we continue to make money to the upside. Okay? Debit spreads can be one of those things, Ken, that can hedge the individual position. And in that individual position, you lower your portfolio risk, correct? So what I'm talking about here is not, and that's the purpose of this class. Last week we talked about individual position hedging. Okay? So if we go ahead, we've got individual positions hedged and all kinds of stuff, and we're still coming up with 2,000 deltas long, but we're uncomfortable with that 2,000 deltas long. We think the market could roll over. Okay? Now let's think about what happens here with this position if we happen to be right. If we happen to be right and the market does sell off, okay? We all know this, that when the market decides to really take off and go to the downside, it moves pretty quickly, right? There's not a lot of warning. We wake up in the morning and the market's gapping down 500 points. Okay? Puts help us make money doing that. So if we pick up 400 negative deltas by picking up some puts, and what I normally do is I try to look at the four major indexes, the SPY, the Diamonds, Q, and IWM, and I look for what I believe to be the weakest of the indexes, and I buy my puts on that index. Okay? I get the value of that because I'm not trading an individual stock, the individual volatility of every individual stock. I get that buffering effect of that component average. Okay? I buy puts, John. And the reason I buy puts, when you just do directional spreads, bear call spreads, you don't actually build a real negative delta position, do you? You got to trade very large spread trades to lay off 400 deltas in risk. Okay, most people don't feel comfortable trading that many spreads. Certainly a spread can help you bring in that delta position, but think about the way a bear call credit spread or something is set up. You have a very small negative delta position on a bear call credit spread. Does that make sense? So you're not really laying off that much risk. It can help you a little bit. It can help you in reducing. It can be a good strategy to employ to bring in some of that directional downside move. Okay. You know, I wish they did, T. I wish the system was smart enough to tell you what your actual delta position is in an inverse ETF, but it's not. If you go in and you buy 100 shares of an inverse ETF, you know what it's going to show in your account? It's going to show you long delta, even though it's inverse and it should be showing you a negative delta position. Okay, I wish they did it. And here's one of the reasons that's the case. When you trade an inverse ETF, the only way those inverse ETFs work is they're trading options, right? And the managers of that ETF are constantly buying options, okay, to maintain a weight that's equal to the market, okay, equal to the index that they're inverse. So they're constantly shifting options around. And so you really don't know in an inverse ETF what your delta position is. Okay? Is it a way to handle risk? Absolutely it is. But it's not a good way to really reduce the risk of a portfolio. Okay? Yes, I buy put contracts on SPY, Diamonds, Qs, or IWM, depending on what I believe to be the weakest of the indexes. Gives me the best bearish pattern, the one that has the best chance, if the market does fall, to really take off to the downside. Okay? So let's say we're correct and the market does take off to the downside. What's going to start happening? Your stop losses are going to start triggering here, right? Stop losses are going to start triggering, and it's going to automatically start reducing this 2,000 delta position long, which means that 20% risk that we started with, or that 20% hedge, automatically starts to grow. Does that make sense, guys? We start triggering off these stops, and all of a sudden our hedge is way greater than a 20%. Okay. Now I can tell you this because I've done it multiple times, guys, is that when I've done this, I have actually taken those really bad days in the market, those really bad days in the market and actually turned in a profit. Because as these stops start triggering, my hedge starts growing. And what happens to negative delta risk when the market collapses or moves down? It goes deeper into the money, right? That's right. So your 400 delta position starts to grow pretty dramatically, and your 2000 delta long position starts to shrink pretty dramatically. Price action, Mitch. It's whatever looks like it has the best price action advantage. A lower high, maybe it's a shooting star, maybe it's an evening star, maybe it's a bearish engulfing candle that gives me the idea that that price action is showing me the weakest of the indexes. Not the strong, yeah, IWM would not be the short place that I would be right now. Okay. And honestly, is there any reason right now to, other than, we're pretty extended, is there any reason in the price action of any of the indexes? We had all new record highs yesterday. All 4 indexes, new record highs. We don't have any clues out there that there's a bear even lurking about yet. Okay, so I'm not talking about tomorrow. I'm talking about in the future when we start to see those warning signs in the indexes. Okay. Larry, yes, I never trade without knowing where I'm going to exit that trade if I'm wrong on direction. Ever. I never enter a trade until I understand the risk and know where I'm going to get out if I'm wrong on the direction. Okay? For me, that's an absolute no-no. I've had that written, well, forever, and we've all heard it too, right? Don't trade without a stop loss. Don't trade without understanding the risk. But we do it over and over and over. I see people do it over and over. What I did is finally, years ago, I finally realized, what's the point of having it as a rule if I don't follow it? Okay? So I always have an exit plan. Okay? We've been seeing that a lot lately, John, where there's some clues out there that things just aren't quite kosher in the market, right? VIX rising, why the rest of the market's rising. When was the last time, has anybody in history ever seen new market record highs in the VIX over 20 handles? In my career, I've never seen that. Okay. So it's kind of a weird situation that we're seeing right now. So we have to be careful. Okay. See, I don't know what you mean by, so how do I get back in? How do you get back in what? We're talking about reducing risk when we're worried that the market could roll over. Okay? Reducing risk when we believe the market could roll over. Okay? So, in this situation, if I'm right on direction, my negative delta grows. My stop losses are triggering, my long delta position shrinks. And if we really get that bad sell-off in the market, you can actually be really soon, you could have 70, 80, 90, 100% of your portfolio shifts to negative delta. Okay? So all we're doing is laying off that risk and managing around that position. Okay? I have before, Tom, if I get kind of that inclination that, two of the indexes are relatively weak to the other two, yeah. But the majority of time I have just found I make it simple. I just go with one index. Okay? Whatever I see as the weakest. I'll give you an example. The 2019 sell-off. Okay, we had the Trump election, the market run up, the big market run up. Anyone that was in right way options knows that we were hedged for that move. When the market sold off hard in 2019, I actually made money on that big wave down. Okay, I didn't lose a bunch of money on that big shocking day when it dropped. My account grew. And isn't that what we're trying to do here, guys? We're not trying to time things perfectly, because would anyone in here be willing to admit you cannot time things perfectly? We don't know what's going to happen tomorrow morning. If we did, no one would ever suffer a loss. Okay? So what we have to do is look for a way to manage that risk. And we do that on the portfolio side by just reducing our overall delta position. Okay? Have you guys ever heard of the term of delta neutral? Yeah, that's what market makers do. Okay, when you and I are buying and selling stocks and the market makers are making those trades occur, you guys know if a market maker doesn't have someone in the market to pair a trade with us on those options, the market maker is required to do the job, make the market, and make that transaction occur. They have to make the trade. Okay? When a market maker is forced to make those trades, if you buy something from the market maker is going to go out and go back into the market, pick up the deltas that they need to bring their accounts back to neutral. Okay? If they keep their deltas neutral, they can ride that market back and forth. Why would if I'm right, Mitch, why would I sell the negative delta first thing the next morning? I wouldn't. Okay? I can tell you this, I'm not good enough after 30 years of trading. I'm not good enough to tell you tomorrow's going to be the day that things fall apart. Sometimes I have to put on this delta hedge and hold it for a few days. If I'm wrong, my stops will automatically take those off. Okay? If I'm wrong, I've already got stops planned in those trades. Anyone in right way options knows that pretty much if I get a stock moving in one direction, okay, I'm almost always hedging that trade. Almost always hedging that trade. So for example, right now, guys, I'm in a position on space. At the close of today, I can actually take a screenshot of this right from my account. No, I can't. I shut my account off. I could bring it back up, but it was 877% up earlier today. Okay? And one of the reasons it's up that much is because I've hedged that position several times and collected premium. Okay. The last premium I collected, I sold calls against space for $13 a share. They're only worth about 6 something today. Okay. I've stayed in the trade for a while because I bought leap options on it. And I've been able to manage that risk, right, Barry? I've been able to manage that risk by hedging the position. Okay. So typically I have hedge trades on all the time on individual positions. I don't usually go to the extent of then hedging the entire portfolio unless I think the market's getting ready to roll over. Okay, if I think there's that real risk out there of a rollover, then I'm going to go ahead, even though I have hedge positions on, I'm going to tally up that delta position and I'm going to reduce my risk to the market. Okay. Is this making some sense, guys? I know this stuff gets kind of deep in the weeds, but think about the purpose. The purpose for this is to manage that risk so you can sleep at night and not have to worry. Okay. What see further examples of a hedge. So let's say I look at the indexes. I look at the indexes and I see a market pattern. Let's say it's IWM. I see a market pattern where the stock has fallen back, rallied up, and we've got a shooting star pattern here showing on the market. And I see that potential of a failure coming into that trade. Okay? The other indexes look weak. They're problematic. Okay? I'm nervous about it. So I take my profits, I manage my stops correctly, put those at where they should be, and then I pick up some negative delta risk. And if this were the IWM, okay, I would go into the IWM chain. I'm typically going to look somewhere between about 45 to 60 days to expiration. Okay. And I'm going to buy an in the money puts. Sorry, I can't write with this thing. In the money puts somewhere around 70 deltas up to 80 deltas. Okay. So if I find a 75 delta position in there, how many puts do I need to lay off or pick up $400 or 400 negative deltas of risk? Yeah, I'm going to need to pick up 5, maybe 6. Okay, so not a massive position. And now the next step, once I do that, if I decide that's the way I go, do you think it would be wise if I have a shooting star pattern here in the chart? Do you think it would be wise when I put on these 400 negative deltas, if that was my impetus for entering the short trade? Don't you think I should have a stop loss up here on those negative delta puts? Because if I'm wrong and that market shoots up through here, I was just absolutely wrong on the signal, correct? Close this position so I can get right back on that positive delta and make money in the market. Okay? So every trade I have will have a planned exit. If I'm wrong on direction. Okay, does that make more sense? So I've got 5 to 6 short puts, or actually long puts. I'm long puts. Okay. I've got 5 to 6 puts out there in the market. The market really starts to fall. These start triggering stops. My long delta risk begins to shrink. My short delta risk begins to grow, correct? And suddenly I am moving this up to 50%, 70% hedged account. Okay? Now we know when a market really starts to fall, like it did the other day. Okay, remember it was just 8 days ago. The Dow was below 30,000. We closed below the 50-day moving average. It was just 8 days ago. Okay. When we move down 500-600 points in one day, and I think that'll be absolutely nothing when this market starts to sell off. We could see big point moves. 500-600 points in one day. Do you think I'm going to make some pretty good money on these 5 to 6 puts on that move? Good money. Okay. I'm packing in some capital on that. Okay, makes some sense. Now, the reason I do this, guys, is because I want to be able to sleep. And I've done this many times. Many times when we look at a market. We go back over here to this 2019 sell-off. If you guys have been trading very long, how many of you recognize this problem? A potential double top high. And then did something about it to protect yourself. I did. Because not one of us could know that this day was going to occur. Not one of us could have known that day was going to occur. But what I did was hedge myself in my account. So if that pattern up here did play out as a failure, I was protected. Okay, makes sense? How about over here? For me, Mitch, if you have a small portfolio and you just have a very small delta position, just set those stop losses correctly or close the trade. If you're really worried of a market failure, you've got an ugly pattern in the market, wouldn't it be better to just take some profit than none? So if it's a really small delta position, yeah, delta or your position is 45, it's really going to be impossible for you to hedge that off effectively with a directional put. What you can do with a 45 delta long position is actually hedge that position. Could you put on a bear call credit spread and reduce your risk of that 45 long delta position? Okay. So there's other trades, other things that we can do to manage or mitigate that risk. Okay. Now, I will tell you, for me, if I am, well, this is the way I would do it. Because I always know I'm never so proud to be in a position to think that um, I can't, if I really believe that the market has a risk of rolling over and I've got that small of a position, I'm just going to close the trade. Because I can always get back into that position. It's only a 45 delta position. I can get back into it, right? I'm just going to protect myself and close the trade. Okay. It's when I'm in that portfolio that I have a fairly sizable risk to the market. Kind of like we have right now. I have a relatively large risk to the market. And the market is paying me to have that risk right now. But we all know we could wake up any morning and see that failure occur. So right now, all of the positions that I have, I think every position I have, there may be one or two that's not already hedged. Okay? All you got to do is add up your delta, Kevin. Just like I said, just add up your delta. If you use Thinkorswim or anything like that, this is a paper trade account over here. My delta is right here. I'm long in this these are just one contract trades. These are example trades that I use for folks in the room. And you can see I've got 174.48 deltas. And one of the reasons that's the case is because I'm already hedged on some of these trades. I've reduced my delta risk on these positions. Okay. So yeah, just add up your deltas. Now, if you have stock, for every share of stock is one delta, right? If you have a hundred share position, you've got 100 deltas long in that stock position. So just add them up. All right. Exactly. No, Jay Clark. No, I'm not going to go delta neutral. Okay. What I said before, if I have 2,000 shares or 2,000 deltas long, I'm going to start with a 20% hedge. Okay, 20% of 2,000 is 400 negative deltas. Okay, and the reason I do that is I can be wrong, right? I mean, I can easily be wrong. I could think the market's going to roll over and then it doesn't. So I don't want to completely ruin my upside opportunities. Can you guys see that what I'm doing here is just simply buying insurance? It's the same thing you do on a car. It's the same thing you do on a house. We buy insurance when we feel that there's a risk, right? A risk that we don't want to take. So all I'm doing here is buying insurance to protect that position. Okay? I'm expecting this to be a short-term insurance purchase. Because if I'm right, my stop losses start triggering on these 2,000 long deltas and I'm making money on these 400 negative deltas. So it's a short-term alteration to protect me for a downside move. If I'm wrong and the market swings up, I'm going to lose some money on these 400 negative deltas, just like you would by buying insurance. And that accident doesn't occur, we pay that insurance every month, right? We lose money on our insurance most of the time. But it gives us that ability to handle the risk of what we've got going. Okay, that's all I'm doing here, is buying insurance. Does that make sense? Does that make that easier to understand? So I always start with 20%. Okay. Honestly, if I felt like the market had so much risk that I needed to go completely delta neutral, you know what I would do? I'd go to cash. Yeah, exactly right, Barry. I'd go to cash. If I thought there was that much risk in the market, no, I'm in cash and I'm going to be sitting on my hands to make sure I'm not tempted to go back in if I think there's that much risk. Okay? Going by the price action of the chart mostly, Vicky. I'm a price action trader. Um, to me, price is the notice that I draw trend lines, things on my charts, but I trade price action. Okay. Let's take a look at this. I'm going to remove all of these lines that I've got up here. And let's just do a little forward thinking. Does anyone think this could create this pattern? Not that it will, but it could. Right? So let's think about that. If this much of that pattern has been created right here, and we suddenly have a bearish engulfing candle at that lower high right here, wouldn't it be wise to reduce our risk to the market? Yeah, that's a head and shoulders pattern. Okay. What if it doesn't come in like this? What if it goes like this? And that trade moves up, pulls back and moves up, and right up here, we get a big old failure pattern in the market. Would it be wise to reduce my risk to the market? And think about a hedge. Okay, that's what I'm talking about. I'm looking at the price action and I'm looking at the risk of that trade, and all I'm trying to do is buy some insurance to insure against the fact that we could get that big down move. Okay? Makes sense? So it's always a price action trade. And by the way, guys, I said this today in Right Way Options, and I'll repeat this over and over and over. If you go back and study price action on any market top, that first sell-off, like right here, is never the problem. That's never, ever the problem. The problem occurs is if we move up here and we fail at a double top or we fail at a lower high. This right here is where the real selling comes in. Okay? Always. That's always where the big selling happens. Okay? Look right here. Head and shoulders top. Where did the big sell-off hit? Right here on that failure pattern. We rally back up and then we fail to make a new high. That's where the selling occurs. Always. Every pattern is the same. Now, I mean, it may be a different formation and that kind of thing, but the selling always begins. The real sell-off begins at that first lower high. At that problem where we don't make a new high and when then the sellers come in. Okay? Every time you point to any chart and you show me the major sell-off always occurs there. Okay? So if we're prepared and planning for that and we can see those moves coming, we can be ready for them, right? Just by looking at price action. We don't have to have a bunch of indicators on the chart to do it. Price is telling us where the risk is. If you sell puts, yes, if you sell puts, you're in a short put position. That's going to make your deltas act as positive deltas. Okay? The put always has a negative delta, but they will act like a positive delta. Yeah, bearish engulfing candles, morning star patterns, dark cloud covers, shooting star patterns, island reversals. All of those kind of things can create that bearish look in a chart. Okay, just like we see in the bullish moves. Okay, just the other side. But we have to look for them, right? We have to look for that problem, that possible failure in that move, and be prepared in case. Okay. Does that make sense, guys? Now, I know this is kind of a deep subject, and this is just not one of those things that's really easy to pick up on, that it's easy to just jump in and say, okay, this makes sense. It sounds good. But I'm telling you guys, until you do this the first time and you really start working through the details, it's kind of hard to get it. If you go back to that idea that what I'm doing is buying insurance for that potential move, and I'm just trying to hedge myself, okay? Trying to protect myself and lay off some risk. I transfer it to the insurance company, okay? It starts to become a lot easier. It's real easy on a market like this to have a lot of long positions, right? Because there's so many charts that are running up and we don't want to miss that. And it's really easy to end up with a pretty long account, right? I have a stop loss. Okay? I have a stop loss. I see a pattern here that shows me a potential failure. And I put on a hedge trade. And I use that example. I've picked up 400 negative deltas. Where does this pattern fail and I'm wrong on direction? Right here. Right? If I'm wrong and the market turns around and comes right back up through there, I better close those 400 short deltas, right? If we move right on through here. Okay, because I'm wrong. I want to keep my long positions making money. I don't want that negative delta trade costing me too much of that insurance. So I close the puts. That's right. Exactly like any trade. Never go into a trade without a planned stop. Okay? It's okay to be wrong, guys. I'm wrong quite a bit. But I've been able to make a career out of trading because I never let that wrong trade get out of hand. Never. I don't care if it's a long trade or a short trade. I never let it get out of control. It fails my perceived direction on the trade, and I close it. Not based on where I want the stop loss to be, but where price tells me the stop loss should be. Okay? Makes sense? Always have an exit. Always know where that exit is before you enter a trade. Okay? We have to know the why for our trade, correct? And when you learn to hedge, guys, it just opens up this whole new world of trading. How many here that are in right way options have learned there are so many ways to make money in the market without having to take lots of risk in trades? And how we can even enhance the profitability of the trade by lowering the risk. Okay? J. Clark, for me, there's no such thing as a mental stop. There's no such thing. Because, okay, I have a mental stop, and then the stock gaps up here the next day. How did that work for me? Now you're emotionally compromised. What are you going to do now? A mental breakdown. I don't I don't I don't do that. Okay? Oh no. If you have a stop loss set to close puts, if it gaps beyond that, it's going to close them. If I'm wrong on direction, guys, isn't it, if you're wrong on the direction, don't you want to just be out? Do you want to try and negotiate with the market and try to outsmart the market when you're wrong on direction? How many in here is willing to admit that mental stop losses just about broke you as a trader? It did me. Doesn't a mental stop loss put you at a emotional disadvantage when the market moves against you? A stop limit says, I want you to get me out of this trade, but at this specific price or better. If you set a stop limit and the stock bounces through that limit, it will not close the trade because you told the broker this price, no less. And the trade can just get worse and worse and worse beyond that point. Okay? So a stop limit says, sell me at this price or better, but no less. So the broker's bound by that rule. If it gaps against you, you don't get stopped out. The trade just gets worse and worse and worse. Okay? Exactly. As soon as you get emotional, we've all done it, right? We've all made the stupid mistake and then tried to revenge trade it or do something along those lines. Guys, it's just a whole lot easier to just follow a set of rules. Okay? When I'm wrong in a trade, when I'm wrong in a trade, I don't have any more. Now I used to have this big chip on my shoulder. Okay. Where I would do an evaluation of the chart and then I would try to convince the market that I was right. Anybody ever done that? Oh, they don't know what they're talking. This is a good company. It has to go up. When my perception of direction has failed, the only thing I want to do is close that trade. I want to be out of the way. Okay, there's no emotional attachment to that at all. It's a mechanical thing. I have no emotional attachment. It's a business decision. Okay? I take so much risk in a trade. If that trade fails, I want out. That's my business decision. It's not an emotional decision. I'm not going to negotiate with the market. And believe me, I am not big enough to convince the market I'm right when the market's going against me. Have you guys ever heard the statement, a market can stay irrational a lot longer than you can stay liquid? It's just like the people in GameStop that were just absolutely set that this was the greatest thing in the world. They're going to show these hedge fund guys. They're going to do it. And they've lost millions and millions and millions of dollars. Accounts have been broken. Okay. Because they won't close the trade. I do. Longer term hedging, I do a lot of individual stock hedging. Okay. But remember, what I'm hedging for in a longer term portfolio is that really big sell-off. Okay. If I'm holding longer term portfolios, I'm going to be managing by the weekly chart. That means I have this bigger space in that trade. Okay. I'm looking at that big breakdown occurring if I'm going to close those trades. If you guys go back, let me show you this. And thanks for sticking around, guys. I know this is kind of heavy duty stuff and not what you hear in a lot of places probably. The 2008 sell-off. Okay. If I'm hedging long-term positions, I'm not worried about this this first move down, right? I'm not worried about it at all. Because those long-term positions were holding support, I'm not worried about it. But when I see the weekly indexes showing a lower high failure and we start breaking support levels, I really probably ought to be thinking about closing some of those long-term trades, right? They're probably already tripping their stops. Okay. So when I manage long-term trades, I manage the long-term chart. Okay. Thomas, what I said, or not Thomas, what I said before is I'm going to do an evaluation of the 4 indexes and I'm going to look for the pattern or the index that I think is the weakest. The one that has the best chance of moving lower. Okay. And that's where I'm going to buy the puts. It may be the SPY, it might be the Qs. I don't know. I don't know which one is going to show as the weakest. Okay, till it does. No, not necessarily. Let's take a look at IWM. This is a bad tick in the market. IWM, if it pulls back, has support here. Okay? Anytime we pull back and there's support underneath, we run the risk of a bounce right off of there, right? So just because it's the highest up doesn't necessarily mean it's the one that's going to fall. Okay? It's strong for a reason. I want to be looking for that chart that's already showing me that weakness, that problem in the chart. Now, it's okay if you wanted to hedge by putting on a bear call credit spread up here. I can get with that. Put on a bear call credit spread thinking this is overextended and probably going to pull back. But I wouldn't make the assumption that this is just going to break down from here. Yeah, it's a bad tick. It's a bad tick in the market. That'll be corrected tomorrow. It won't be there. Okay. Yes, as a condition, Jack. Let's say I planned a long entry trade into IWM in here. I see this nice little consolidation. I say if we break above this, I want to get long that trade. My stop loss will be underneath this tail. Okay? Because that's where price action said buyer stepped in. Okay? If this is an option trade, it will be an option trade that says if IWM closes down below this level, close this option trade. It'll be conditioned on the stock that I'm trading. So break the price support, close the option trade. No, I don't think that's what that is. I think it's just a bad tick in the market. You know, every once in a while there'll be a weird data thing that goes through, and honestly, you see it quite a lot. And then they correct it the next morning. So, okay, JJ, it hasn't been posted yet. It will be posted in the members e-learning section. Last week's was a members e-learning. It'll be posted in the members e-learning section. Okay, of On the Right Way Options membership page. Okay. Just hasn't been posted yet. Haven't had a chance to do it. Okay. And by the way, guys, every trade is the same for me. Let's take a look at AMD. Okay. I looked at this price pattern in AMD right here, and I saw the potential that this stock could fail. As a matter of fact, we tested here several times to try and break that support. And so I put on a short trade looking to see if that could fail. But I said, because this is support, I'm not going to take a lot of risk on that position. Okay? Because we can hit that support and bounce right off of it. So what I did, I'll go to a naked chart here. And at that time when I put this trade on, this candle had been formed. So my stop loss was right there. I don't take unnecessary risk in a trade. If I'm wrong on direction, I get out of the way. Okay? I get out of the way. So my trade was planned right here. I had a short planned, didn't work. I'm out of the trade. I don't care. I protected my account. That's what I'm here to do. Make money. When the trade is wrong, fess up to it and get out of the trade. So it was a position that said if the stock was at or above that price, close this option, close the trade. Okay. Yes, John, is there going to be some slippage? There's always slippage in options, right? Always slippage in option. But let me ask you this. If you're short this trade and this breaks this high, do you want to argue about 15 or 20 cents? No. Get the heck out of the way, right? I've seen people lose tons and tons of money they're tripping over pennies. Okay? Just get out. Get out. You're wrong, get out. And by the way, guys, when you're wrong on a trade, is it show you in a bad light as a trader? Should you have an emotional attachment to that trade that says I'm willing to fight for it? No. There should be no emotional attachment to it whatsoever. This was my plan for the trade. The plan failed out of the trade. Okay? It's not personal. Market doesn't care. And that's one thing it took me forever to learn, guys. It really did. I struggled with this for a long time. The market doesn't care if you lose money. You go to Las Vegas and lose money, they're going to keep bringing you drinks. They're going to comp you meals. They might comp you a hotel room. As long as you're losing money, they're going to be the nicest people in the world. Do you ever get a sympathy card from the market when the market takes your money? Do they comp you a meal? No, it's heartless. Okay? When they take your money, it's over. It's done. No emotion in it whatsoever. They don't care. Empty your account, no problem. All right? It's business. It's just business. It's not personal. Okay? So when we put on a trade, if we attach a personal ego to it, we're really putting ourselves at massive risk in the market. Okay? I don't use trailing stops unless, let's say I'm in a trade and it gaps up in the morning. Most people know from right way options, if I'm in a trade and the stock gaps up, first thing I do is I come in the morning. Hey, thank you very much. I enter an order to close the trade. I'm out. I did my job. I made my money. I'm going someplace else. I don't even give it a second thought. I take the profit. Market just gave me a gift. I take the gift. Okay? So the only other time is if it's something that gaps and looks like it's really going to run big. And by the way, guys, by doing that when a stock gaps up and I don't even question it, and I just close the trade, I often get the highest price of the day. I mean, look at them right in here. You're in this trade and the stock gaps up here in the morning. Close the trade. That was the highest price of the day. Stock moves up and gaps up to here in the morning. Take it. Okay? Take those trades off. Okay, so I don't use trailing stops. Unless I'm in that position, it gaps up, and I think it's going to be one of those fast runners for the morning where it could just escalate up for a while. Then I'll set a trailing stop. I'll just trail it by a few cents or whatever it is, and then I'm done with it. Okay? I don't even look back at it. My order's in. The order's going to take me out of the trade. I'm done. I made my profit. The only thing I'm here to do is look for my next trade. Okay? So I don't use trail stops. Okay? When I place conditional orders on a trade, it's always close at the market. Okay? When the stock is greater than or equal to or less than or equal to that price that I set as a conditional order, close this trade now. Okay? I'm out. That's the only way I know how to control my risk, guys. When I did the other things, when I tried to be fancy, when I tried to, well, isn't it true, guys? How many of you guys have had a stock gap for you, and then you spend the rest of the day staring at that chart? You don't do anything else. You spend the rest of the day staring at that chart, and isn't it true? A lot of times you end up closing it for less than if you'd have just closed it. Right? If you're honest with yourself, that's true. Okay, so why mess around with it? Why waste your time? The market gave you money. Take it. Go find the next trade. And believe me, guys, once you get with that attitude, it's so wonderful. How many of you in here would agree that when you came to Right Way Options and learned the art of taking profits, it just feels good, right? Because it's a winning trade. Get in the trade, make money, it's a winning trade. Get in the trade, make money, get out. It's a winning trade. Get in the trade, make money, get out. It's a winning trade. It grows our accounts. Okay? That's something you'll get over after a while, Lee. I don't care if it continues to go up if after I've closed the trade, because honestly, think about it. Was that money ever yours? No. The money that the market gives you, when you take it, that's yours. Anything beyond that is not yours, and it never was. Be grateful for what the market gave you and look for your next trade. Looking back, agonizing over something like that, isn't that a waste of time? It's also a waste of emotion, right? What part of that is really business? Yeah, it messes things up, right? Move on, find the next trade and do it again. And do it again and do it again and do it again. Okay? Exactly. Every day is another opportunity. There's always another trade. Close the trade and move on. It's another thing that I teach all the time. Isn't it true, guys, that we have worked really, really hard in the past trying to figure out how to outsmart the market and make a bad trade into a good trade? A lot of us have done that, right? We will work our tails off trying to make a bad trade into a good trade, trying to be really creative and make a bad trade into a good trade, when the best answer would have been close the bad trade and move on, find a good trade and make money with it. Okay, it's easier. When you take small gains, what we call base hits, I want to ask you guys, if you took, and this is the last thing I'm going to talk about tonight, okay? If you make two $100 trades in a week, okay? $100 trades times two. 52 weeks. How many of you would be that would be the best year you've ever seen in the market? Okay? Most people don't think about that. And I use this analogy. If you're walking down the street with me and a $100 bill blows across the sidewalk in front of you, are you going to tell me you're not going to bend down and pick up that $100 bill? Right? We're both going to bang our heads together because we're both going to reach for it at the same time. Okay? But we let $100 bills blow past us all day long in the market because we're too proud to pick them up. Think about that. Consistently profitable traders take profits consistently. Okay? There can be no other way. You cannot be a consistently profitable taker or profitable trader if you're not taking profits consistently. You're not going to ever be a full-time trader unless you figure out that you have to take profits consistently if you're ever going to be full-time. Because you got bills to pay, right? They come every month. We've got so much we have to cover. We have to learn to take profits consistently. Okay? All right, guys. Take care. Have a great evening. What's left of it. Thanks for being here. You guys are diehards. I appreciate it. This is kind of a heavy subject. I'll try not to be quite so heavy on the next public e-learning class. But hopefully you got something out of this on how you can help manage a position. You can sleep a little bit better. Understanding how to buy some insurance to protect a portfolio. Okay? It can help you a lot in the long run. All right? Everyone take care. Hey, awesome, Mitch. Looking forward to it. Everyone take care. Have a great evening, and we'll see you bright and early tomorrow morning with the morning market prep. Take care, everyone.